Today, I'll give you 3 investment books that have really shaped my investment philosophy and a bonus 4th book on option trading that I was required to read during my option trading internship on Wall Street. If you want any of these books or others I suggest, I'll link them down in the description below. I'll also be summarizing these books, saving you time and money, so make sure you watch throughout the whole video. The first book I have is The Intelligent Investor. Since this book is by Benjamin Graham, Warren Buffett's mentor, it's hard not to place this book as number 1. It's the complete value investor's book that will teach you how to invest for the long term. The Intelligent Investor is a book that aims to help people invest in the stock market while minimizing risks. Graham was someone who bought cheap value stocks that had no more downside and would squeeze 20 to 30 or even sometimes 50% from them. But the book also focuses on long-term investing and more risk-averse approaches. Here's the lessons that I learned from this book. Buying into the hype of a strong bull market is a common mistake many investors make. Also, Graham says many investors are not doing their own research. They rely too heavily on experts who aren't necessarily experts, aka every YouTuber who doesn't have a finance degree or Wall Street experience. Also, not staying humble when your stocks are performing well. Now, the book also teaches about inflation. That's why this book is far from outdated, even though it's a value investing focused book, since inflation is something that regardless of time is always going to be a factor in our economy. Cash becomes less valuable over time. For example, $1 10 years ago is worth more than $1 today. Therefore, instead of holding on to cash, we must be investing cash so we can beat inflation. Despite this, the majority of investors do not take inflation into account. Now, psychologists call this the money illusion. A 2% raise in your salary is effectively a cut in our available money if inflation has increased by 4%. Despite this, people generally prefer this scenario than taking a 1% pay cut during a year when inflation is 0. In the first case scenario, you're down by 2% relatively, and in the second case scenario, you're down by 1% relatively. However, most people don't understand inflation. So you should be measuring your investing success by how much you keep after inflation rather than by how much you're making from your investments. Graham explains that stocks tend to outpace inflation 80% of the time. So that's the reason that you want to invest in stocks. Now, the Intelligent Investor also taught me defensive investing, and here's where things get really different from growth investing in our current market. Graham believes that the defensive investor should have a minimum of 25% of their savings in bonds. Now, I don't completely agree with this, and he says that a maximum percentage of 75% of their savings should be in stocks. I believe we can go 100% in stocks as long as you pick the right stocks. Graham also advises against buying lots of stocks in tiny increments over many years. Although diversification is essential, buying so many stocks in such a small amount will make your tax returns very challenging. So, if you're not prepared to keep an in-depth record of all of your investments, you should not be investing in 30 or 40 or 50 different companies. It also makes it very hard to become an expert in what you're investing in. Try to invest in 10 to 20 stocks at the start and make sure that you invest in multiple different industries. When choosing stocks as a defensive investor, Graham recommends considering a few things about each company. Number 1, how large is the enterprise? Choose larger and less volatile companies. Now, the interesting thing is when I was doing research in college studying finance, I learned less volatile stocks have historically beat the market rather than the risky growth stocks in most cases. So don't be fooled, a very safe and low growth stock can actually outperform the market. Number 2, assets should be at least 2 times liabilities, and long-term debt should be less than the net current assets. A company that can cover debt is going to be a much better investment than one with tons of debt and very little cash flow. Number 3, positive earnings should be recorded for the past 10 years. Now, this is very important because you want a profitable company and not a company that is just burning cash. Number 4, dividends should have been paid out without interruption for the past 20 years. It goes without saying, if a company can't pay its dividends, then you have a very big problem on your hands. Now, number 5, the per share earnings should have a minimum increase of at least 1/3 over the past 10 years. Number 6, the price to earnings ratio should be no more than 15 times the average earnings of the past 3 years. Now, in the next book I'm going to discuss, it's going to be a more growth approach, so don't worry, I'm going to talk about growth stocks and how you can pay more than 15 times earnings, but there's many different stipulations if you're going to do so. I hope you're taking notes and writing things down. You can rewind this YouTube YouTube video because these metrics will help you pick better stocks. Number 7, the ratio of price to assets should not be more than 1.5 times the book value last reported. Plus, the PE ratio times the price to book ratio should not be more than 22.5 times. So this is what Graham calls an evidence-based approach to investing. He also says market volatility can be scary, but it is also an opportunity to make a lot of money. Graham explains that a paradox exists where the more successful a company is, the greater its fluctuations in its share price. So you should be aiming to buy a successful company stock when they hit a low price point. He describes creating a margin of safety in your security analysis, so even if you are wrong, you have built enough return during your research process. Lastly, although I worked in financial advising and I really wanted to be a wealth manager, the book describes how financial advisors just take fees and they don't provide enough value. Now, I'm going to be sending some important information over to your email about becoming your own financial advisor without having to pay anyone else. So make sure you sign up for the free email in the description. And if you don't mind, hit that like button for me. The next book is Common Stocks and Uncommon Profits by Philip Fisher. If Benjamin Graham is the dean of value investing, Philip Fisher is the father of growth investing. And this is where things get really interesting. The book was published in 1958, but after 63 years, it's still as relevant today as when it was published. This book has really shaped a lot of what I believe in and the growth stock investing that's going on today. Now, Fisher is the first to focus on fast-growing companies, and at the same time, he has a really long-term focus, just like myself, saying that the best time to sell a stock is almost never. Long before Warren Buffett actually said that his preferred holding period is forever. Now, Buffett called Common Stocks and Uncommon Profits a very, very good book in the 2018 Berkshire Hathaway annual shareholder meeting. Fisher insists on very deep research. I agree with this, and I limit my portfolio to less than 10 stocks in my main portfolio because of this reason. You must collect as much publicly available information that if you put the pieces together, you see something that other investors don't see in the bigger picture. That way, if and actually when a stock actually falls, you have enough conviction to go against the grain and against the herd and buy shares when everyone else is running for the hills, because that's when money is really made. This is especially important since right now the market is at an all-time high, but I don't think that every growth stock is priced accordingly. I also think that some companies look expensive like Nvidia, but may actually not be expensive if there is enough growth ahead. Third book is One Up on Wall Street by Peter Lynch. Peter Lynch managed the Magellan Fund at Fidelity between 1977 and 1990 when he retired. When Lynch started out, the fund had 18 million in AUM, or assets under management, and when he stopped, he had 14 billion in AUM, and Lynch actually averaged a compounded annual growth rate of 29.2%, making Magellan the best fund in the world. It's also the best fund measured over any 20-year period ever. But while Lynch averaged 29.2% per year, turning $100,000 into $4 million over a period of 13 years, the average Magellan investor achieved a return of just 7% per year. That's because far too many investors overtrade stocks. Also, one of the best investors of all time averaged 29%. That's why I completely laugh when people say that they can 5 times their money fast through some get-rich-quick method. It just doesn't work that way. If it were that easy, everyone would do it. Now, Peter Lynch does simplify investing in the book by even saying that all the math that you need, you learned in the 4th grade for investing. He assigns his investing success much more to the study of history and psychology more than even his MBA. Lynch is firmly convinced that individual investors like you and I have a competitive advantage over most professional investors, funds, and institutional investors. They have to follow rules, written and unwritten, about diversification, sector allocation, company size, and so on. However, we as individual investors, we don't really have all these rules and stipulations. Funds choose for certainty over potential. Lynch stresses investing in things that you know and that you understand, very similar to Warren Buffett. Open your eyes and your mind and look around on the streets, on your job, in your free time. Look around you for investment ideas. There are companies everywhere that you can analyze and invest in that other people don't understand as well as you do. He stresses the importance of the earnings of a company, and if you buy a high growing company, you can make a killing and outperform the market. If you correctly predict that the growth will continue, that stock can absolutely crush it and become a multi-bagger stock. What I learned from Lynch is to look at as many aspects of a company as possible. Look at their products, look at how the company actually makes money, where they make money, where their profit pools are, look at the management and growth opportunities. All of these aspects of a company, the more you understand, the more you'll have conviction in the stock and understand the future trajectory. You should really know why you own a company, and the stock price should not be an argument to buy or sell. So that's one of my favorite books. Now, as a bonus, the last book is Option Volatility and Pricing by Sheldon Nadenberg. I was given this book by a very successful option trader as part of my first internship, which introduced me to the world of options at 19 years old. And he gave me a copy of Options Volatility and Pricing and asked me to read it. He said he started trading with more conviction and higher returns after reading Sheldon Nadenberg's work, and he said it had been an invaluable resource for him. The book was now part of the training course that he makes students read when they start becoming option traders. Now, I think at the time that I didn't really have enough experience. I was just 19 years old, so having a lack of experience, I didn't really have the biggest appreciation for the book and all of its contents. In fact, all summer I read the first 8 chapters many times out of the book, and I didn't completely understand it, and it was far too challenging for me. But I still recommend trying to understand option concepts the best that you can, and this book did end up helping me tremendously. Many of the chapters contain practical advice on buying, selling, shorting, and hedging given a specific set of market conditions and parameters. Now, the book has gone on to become one of the most widely read books amongst all active option traders around the world, and I'll compile everything for you guys in the description. I hope you guys really enjoyed this video. Again, I'm going to be sending out emails on becoming your own financial advisor, so make sure you sign up for the free email list, and I'll see you guys back here very soon.